So basically, this just means that the ETH yields are starting to decline. There's about 612,000 active validators on the network that is sharing all of this daily rewards. And there's almost 100,000 new validators waiting to get in line. And there's only 1,700 looking to get out. Right? As these validators start coming online, those rewards have to get scattered out amongst even more validators.
Welcome to your weekly Alpha Bites, an inside look into the minds of analysts hunting for tomorrow's alpha. Today, this is Marconi White, and on this week's show, we're going to be asking what really matters in crypto, including what a little-known metric tells us about when the market may reverse. Does ETH Validator income shrinking mean we've hit peak staking? And are Blur loans worth the squeeze? And a whole lot more. In the studio today, we have JJ, Ben Lilly, Cody, Ray, and for the first time joining us, Benjamin. Gentlemen, welcome. We've got a lot to cover. Let's dive in. So I'm going to start with the market update here because, there's just always a lot to talk about. Over the last week since we last connected, we saw a pretty sharp drawdown for many assets. Assets such as Cardano and Solana saw a 20% pullback. Even Bitcoin and Ethereum saw a pullback. And then today we received news that the annual CPI decelerated to 4% in May, the slowest since March 2021. That came from Bloomberg. Someone should fact check that. So I'm going to turn it over to JJ. JJ, I want to know, what is the market signaling?
Yeah, like you said, that CPI report really made some moves in the market today. So we saw the dollar slide down. DXY retested its 100-day moving average at 103.02. It's bounced from there so far, but it's not really the best looking bounce currently into FOMC tomorrow. We see that the federal funds future rate, which is kind of a basis of the terminal rate, the market's expectation of how high the Fed will hike, that's been rising. So ultimately, the market's kind of expecting a pause tomorrow. It's now priced in at 99% that they will pause tomorrow. And we see that reflected in DXY. It's kind of stalling out here. The RSI on the weekly chart, it's kind of reverting from the 50 range, which is where it got up to in March, just before it reverted back down to 100. And again, on the daily chart, it's also at that 50 range, and it looks like it's reverting. So obviously, the crypto markets have had some bearish news headlines of late, all the SEC actions and whatnot, but that could be a bit of a red herring if the dollar takes a downturn here based on what comes out of FOMC this week. So keep an eye on that.
So, in the chat, you were talking about this being a sort of risk-off market, and then we saw the news today. It feels like it's a little bit of a mixed bag. How do you think traders are looking at this? Are more of them going to be leaning into a risk-off, or are they going to be trying to go bullish, perhaps with some option activity?
It's very... So there's mixed signals right now, right? So like Bitcoin's lost all of the trend lines except for basically the 200-day moving average that it rode up from the bottom. So you kind of have this mass indecision. So we see, like I said, the dollar's looking weak, but at the same time, Bitcoin is losing its trend potentially. And with a headline event like tomorrow, the downside risk is very strong if, say, the rhetoric is more hawkish than expected. We see gold's had a pretty significant pullback today, so that's not good for Bitcoin either with that. If that kind of continues there and it slides back down to, say, 1930 or below, the stock market, S&P, NASDAQ, and small cap all look a bit overextended, like they're ready for pullback. So you have all this potential for lower here. At the same time, the dollar's kind of signaling it's going to go lower as well. Not to say they all can't go down in connection with each other in a short amount of time frame here. So that's one possible outcome. But it doesn't, there's no clear signal right now, which is ultimately what you expect into an event as major as FOMC. So just kind of monitoring those correlations. And I think sooner or later this week, we'll kind of see a definitive break in one direction or the other, which will kind of give us a hint of what to expect for the rest of the summer. But there's nothing that you could make a definitive call on as of right now.
Still too hazy, a little bit of that fog, that market fog. Ben, I want to ask you, you've mentioned several times on this podcast about looking for that break below. What's your confidence level? Are you still just sort of waiting? Do you feel like this is signaling maybe we're getting closer to that? How are you looking at the market?
There hasn't really been any sort of decision taking place in the market one way or the other. I think JJ just really hit that right on the head of just nobody has that certainty to make those moves. And there's no point in trying to get ahead of it. You might as well just kind of wait for it to come to you until that moment happens. When does it happen? My thesis, I think, is still intact there. I didn't expect for it to happen this early. I was anticipating more of August timeframes. That could still play out here, but something needs to give here, one direction or the other. I mean, looking at these CME projections for federal funds rate, things are changing almost daily. So this market is, you can't make those assumptions and stick to it. You have to be flexible.
Right, you have to be flexible. I imagine some people have some dry powder, so they're kind of holding on to the same thesis that you have, waiting for a little bit more of a break to see if it's time to deploy some of that capital. I guess, JJ, from your perspective, you're looking for direction one way or the other. I think I ask this almost every week. Like, what would you expect if we're looking for some downside? What would you look to be a healthy kind of continuation to the downside versus something that would make you pause and think that we've, more concern coming with the way the direction's going?
I think if we do go to the downside, I would want to see price stop above the 200-day moving average, which is currently, I think, around 23,600 or so. Mm-hmm. So I think anything in like the 24.5 range or so, that would kind of be a healthy wick below if we could quickly recapture the trend. But I think if it gets down to the 200-day, I think I said this last week too, like I don't have much, all the trend lines above it are exhausted, right? So as price moves down, if everybody's looking at the same 200-day moving average and that's where they're going to enter, if price gets down there, it tends to not bounce for that reason because the trend's already exhausted. You've kind of lost the momentum, and that you might get like a final bounce from there, but it's unlikely that will sustain a continued rally for the rest of the year. So I would want to see price catch itself before it reaches the 200-day. So anywhere in the 24 to low 25s would be healthy if it can get back above, 27 within the coming weeks into the monthly close.
Which I'm thinking about some of the discussions we've had of late. It feels I'm going to be less confident that's going to happen, given sort of what we talked about in terms of the summer, expecting more of that to play out later. If it's happening earlier on, that's giving me a little bit of a pause. Gentlemen,
the dollar to break down here. I think that's the most crucial element here, is that if tomorrow is, say, more dovish than expected somehow, and they're kind of easing up, they declare a victory on inflation, we could see the dollar kind of lose the 150-day moving average that's rode up throughout the past month, and then potentially break down below 100. In that scenario, it'd be hard not to be bullish, I'd imagine.
It's hard to imagine them declaring victory on inflation. I feel like the opposite is going to happen. They talked about inflation in such a light way as it was climbing. Now I feel like they're probably going to be doomsayers until it's potentially dead in the water and everyone's just screaming for life because the market's completely capitulated.
I'd have to agree on that. I mean, you look at those December meeting expectations and they're still pricing in, 4.5 to 5%, just really 1 to 2 cuts being priced in right now. And you can tell they're trying to work that a bit higher. The dates prior to that have adjusted quite a bit, thanks to that hawkish language of just, we really got to keep staying true to fighting inflation. And so we've seen those probabilities adjust to less prediction of a rate cut. And instead, just this terminal rate of around 5.25 is going to continue on for longer.
4% is still well above target too. It's double their 2%, what they stuck by. So it's probably very unlikely that they would do anything drastic tomorrow.
And our own resident here, Ray, knows that those prices are probably lying because he keeps on buying beef and it just doubles. Sorry, your steaks are so expensive this summer. Guys, anything else on the market that you guys want to share?
I'd like to say, there's this opportunity. So when altcoins see a double-digit drop across the board and Ethereum pulls back by 7% and Bitcoin drops 6, 7, or 8% in a day, those aren't common events, and they tend to rock kind of like standard deviation and average prices throughout the market. So while centralized exchanges going through these rough times and possibly like a paradigm shift in the way that they operate does shake one's confidence in the market. I don't think that it alters the fundamentals of certain projects within this crypto market, which have been around for multiple years. And what a patient investor should do is look at those projects which were doing well and still have demand and see a lot of users using them, or they have good kind of like product to market fit, to use that cliche word. And look at which projects are way off valuation simply due to liquidity issues or cascading liquidations or just general FUD, and think about whether or not that would be a good investment, whether it's just a snapback trade, like a momentum trade back to the average price, which can get you a quick 20% return, or is this a time to add some seeds out to your field and begin to kind of water them and prepare for the next cycle? So it's spooky, but I think investors always kick themselves in the leg when they look back on these things and they're like, damn, I should have been buying there.
Yeah, so I think that's good advice for those who are newer to the cycle. I think if you've been through previous cycles, perhaps you're battle tested and know that these can be good buying opportunities. If you're newer, to your point, Ray, it can be scarier. So yes, I think that can be, not that we're offering financial advice. That's not what we do here, just our opinions, but it could be something worth considering. But let's use that as an opportunity to transition to looking at some of the data that we're seeing in the marketplace. And our newcomer here, Benjamin, is going to be sharing with us a new metric and how it can be used to be looking at reversals in the marketplace. So Benjamin, welcome. What's on your radar? Walk us through what you have with this CARI metric.
So CARI is basically correlation adjusted reversal indicator. The way to use this or to interpret is it tries to see where there is a very high correlation between the returns that you see in the asset pricing and the price of the asset itself. And when this gets highly correlated, and this is more oscillatory metric, I'd say, and when it gets highly correlated, we are predominantly at the end of the local rally, I'd say. Historically, in our charts as well, we've seen that. And what we see when we compute that metric over the past couple of months is that we have hit those levels a couple of times. While returns have, on a 30-day basis, have started to deplete on BTC now, during the April-May cycle, they hit the tops quite a couple of times.
Benjamin,
So
let me break in here because I want to make sure I can translate some of the quant speak, because I think there's a lot of alpha here to share with the audience. So first of all, you mentioned it being an oscillator metric. Can you just break that down for the audience, what you mean by that?
Yeah, sure. So you have to visualize it as something between 1 and -1. So 1 being the highest correlation between the returns and the price, trending situation, and -1 being the negative correlation. So when these two metrics are negatively correlated, you still have a trending situation, or the asset is safe in order to invest. But when these two metrics are highly correlated, so that's basically when the inflection point basically appears. So that's why it is oscillatory. It is between 1 and -1. That's how it's constructed. So it's one of the metrics that we try to use to see if, on a quarterly level at least, if we have reached like a cycle top, and if we have to reconsider rebalancing our investments on the spot markets at least.
Okay, so no, that's helpful. So you're suggesting that this specific metric is it saying that we've kind of reached the top of the local rally? We're now looking for a reversion to the mean?
Yeah, our initial outlook was that it would still be a sell in May and go away for a shorter period, at least for a quarter. That was the initial outlook as well. And given that we hit the roof on this CARI metric in May a couple of times, in fact, I think we are going to have a continued correction period for the coming quarter as well. And probably we have to see how things change post-September.
We just had a conversation about what's in the marketplace from a macro perspective. How would you use this metric? I mean, are you combining it with those other data points? Are there other metrics you combine it with to bring better or higher confidence that the market is about to go to a reversal?
Yeah, I mean, in this case, this metric basically tries to tell us only the topping situations. It doesn't help in bottoming assessments. So for bottoming, typically we use our ROSI metric, or if we use whether we have reclaimed the yearly open. There are various ways that we try to see if we have a strength in the market, such as the bid-ask ratios, order flows. There's multiple things that's involved in order to determine exact bottoms, but we have also not seen a flush in the open interest. So I think we are still a little far away from saying the bottom is in for this year. We have to wait and see how things play out the coming quarter.
Okay. For all the new listeners, we're not always this bearish. We're just realists. I just want to give everyone a little bit.
I mean, we could just go sideways, to be honest. We could just go sideways between 23 and 28 for another 2 months, and the volatility can just keep compressing for another 2 months, and I think may just happen. Why alts can keep bleeding? Around 25% of the altcoins on Binance futures are already below their yearly opens, so that is typically considered bearish for those alts at least. So we have to just wait it out, and probably a lot of alts are also going to follow that and bleed down to their yearly opens, and then that would be a good triggering point to see, okay, how many of the assets have reset their entire pump cycle of 2023, and then we have to reassess if we can enter those assets for a rally that leads into the halving.
Understood. Ben or JJ, did you have something you were going to bring in?
No, I think that's it's pretty spot on. We're already up 70% on things like ETH, and Bitcoin was up well over 100% from the FTX lows at some point. So kind of pulling back from here, and especially the lack of spot demand that we've seen, the lack of market liquidity, and like Benjamin mentioned, the liquidity that's still open lower. Those things just form a target the longer those positions are opened in illiquid markets. So kind of a shock lower, stab lower from here wouldn't be the most surprising thing in the world.
Yeah, I was just going to jump in and ask a question really for Benjamin, which was more about this metric. And when it starts to flash this sort of reading, is it sort of understanding that there's this behavior that gets replicated in terms of how liquidity would move in and out in these different assets that tends to alert the system that, hey, this does look like a reversal indicator. The liquidity is maybe all moving out, so the correlation is what it is, and therefore that's the reading that we get.
Kinda. Actually, we can, if we look at liquidity in these peak points on CARI, in fact, we can see that liquidity was at peak when these triggers basically came in. So there is also this theory that when liquidity is extremely high, right, it's extremely good, that's the time to get scared, because that's when you probably see a lot of offloading happen that you wouldn't expect, because when that liquidity suddenly disappears, all the traders who were complacent in their positioning, they get affected. So whenever there is a very high amount of bid volume and ask volume, like if bid volume and ask volume basically has hit all-time highs, which often happened in the past couple of months with Binance, in fact, and that is a bit of a scary situation because you don't know when it will get pulled. And when it gets pulled, even 10% pull is good enough for a huge reversal downside. That's basically what happens from the market maker side as well. So yeah, there is a bit of a relationship with the liquidity over here.
It's a bit of a distribution. You kind of have to churn up the waters, get the volume cranked high, allow that distribution to unfold, and then pull the plug.
Benjamin, let me ask, is this metric available publicly? Is this something that's used in private?
No, it's not available publicly. We just have it in private at the moment, but hopefully we'll try to find a way to make it public for users.
So if you're interested in metrics like this, I suggest you stick around, because some of these guys are going to be able to share them here. And at some point you may be able to hear where you can actually get your hands on them and play with them in the wild. This is something I would suggest we bring Benjamin back for as the market continues through the summer, and we're looking for whether reversals are happening, if they have happened, as we start to look at where they're going to go from there. Ben, let's move over to you. I think you have some topic here around Ethereum and some of the revenue. So Ben, what's on your radar this week?
I'm worried this is going to be a very bearish podcast. I'm like hesitant. Like, do I even want to go ahead with what I got today? But you know what? We're already in, so let's just keep swimming.
Bottom then.
I'm going to suggest everyone starts with some whiskey. Maybe this is our Jim Cramer moment. We all just come.
Yeah, exactly.
We're the inverse signal. So let's see. Please bring on your bear, Ben. Bring on your bear.
Okay, so I got the validators are rising on the Ethereum network while the daily validator income is stalling out. So basically, this just means that the ETH yields are starting to decline. If we want to use some good old TradFi yield talk, we got the bear steepener on our hands. So what the heck does that mean? It just means that yields are starting to decline, likely because of the economic activity taking place on the Ethereum network. But there's a second point that is kind of important here, which there's about 612,000 active validators on the network that is sharing all of this daily rewards. And there's almost 100,000 new validators waiting to get in line. And there's only 1,700 looking to get out, right? And now we just said that ETH yields are starting to compress. And as these validators start coming online, those rewards have to get scattered out amongst even more validators. So right now, ETH yields just hovering above 3.5%. And once all these validators come in line, assuming nothing changes, these yields could be dropping below 3%. So, that opens up the door to like, what are you going to do with your ETH? What's your long-term expectation over 3 months with ETH? Do you think it's worth staking? Do you think it's time to go explore other opportunities? It just opens up a lot of questions in my opinion.
So yeah, it does ask a lot of questions because we've been talking about the fact that validator queue has been growing. We did talk last week. Cody mentioned that we're starting to see some exit, but most importantly, we're starting to see that compression. So where in your mind would you be looking to see that activity go? Are you just going to be looking for selling a spot on exchanges? Are you looking for to move to another chain where maybe people can get higher yields? What kind of signals are you looking for?
Yeah, so this is it opens up the door to a lot of questions because in TradFi world, you go ahead and you look at kind of the most pristine form of bond you can get your hands on, and that's a U.S. Treasury, and that's AAA credit. And you have this whole credit rating system to understand just really how far down the risk curve you're going, right? When you get to corporate level bonds, you have this rating system to help you, forget what you actually think about S&P and Moody's and what they do with actually ratings. It's still helpful nonetheless. But when it comes to protocols on Ethereum and really any protocols in general, and you need to go ahead and stake, you don't necessarily know how risky that yield that is being offered up is. And right now, I had big hat tip to Cody because he went and just went ahead and grabbed all this data and started to do some calculations to help me out here. But we went ahead and checked out some other yields out there, just looking at a V2 Uniswap pool. Staked ETH to ETH swaps. I mean, that yield is hovering around 10%. Right now, it's about 12%, but it hasn't gone below 5% since Q2 2021. And now we're talking about ETH staking possibly falling below 3%. Opportunities like this are out there, but a lot of the question comes down to, is the yield advertised, and I see on some web page the yield that I would actually receive. And I think that causes a lot of hesitation. I mean, you even find some protocols that are like 3-figure percentages, and like, is this true? I have no idea, right?
Yeah, well, and you have to ask where they're getting the yield from, right?
Yeah, where's the tail risk?
I feel like there's a need for the market to become far more sophisticated on risk management. And I think the knee-jerk reaction is, the easiest one is we'll stay away from crypto. Then the next one is we'll just invest in Bitcoin. And then a third one, and then they say, well, you're moving down the risk curve when you start to look at these other protocols, and they make it sound, well, either you're going to get rugged or you aren't. And there's demand, as you're alluding to, Ben, for a more sophisticated way of measuring this risk.
Absolutely. That's just, one facet that we could explore. I mean, the other one is, what's your 3-month, 6-month investment horizon in terms of, do you have a bullish thesis in mind? Do you have a bearish? Because if it is bullish, right, the question of dropping ETH into a DEX pool that might suffer some impermanent loss comes up. But if your expectation is that maybe the market goes sideways, which we've discussed earlier, for 3 months, that opens up the door to, say, a swap pool of like ETH USDT or USDC. Granted, the USDC ETH pool is not as attractive as in terms of yield. It's hovering just above 5% on our 30-day moving average. But maybe the USDT pool is a little bit more attractive. But if it does become more attractive than the staked ETH to ETH pool, right, that opportunity, if your investment horizon of 3 months with a kind of neutral price angle, that's another opportunity. We haven't really had those discussions, I don't think, in the market of what are you going to do. And let me just preface this by saying this has to introduce eventually these secondary markets that start to kind of take those guesses on yield and hedge it out.
Right. But we're not there yet. And I guess a simple yes or no, Ben, do you envision us getting there during, let's just say, in the next 18 to 36 months? Yes or no?
Yes, absolutely.
Okay. Well, we're going to be monitoring that and looking at that as it matures. JJ?
I was just going to say, I agree with that. I think we do get there too. You can see it coming. It's just a very slow process. It's like evolution. It's always happening, but you don't necessarily see it on a day-to-day basis. It's only when you look back in the rear view of months, or in some cases years, where you see the progress that was made.
And guys, for everyone who's asking, that is JJ being optimistic and positive. His voice, that's exuding the love that he has for this space, and he can't wait to see it change. Again, more to monitor here. If you're interested in how this is going to evolve, I suggest you check in every week to hear, as we're going to be covering this. But let's continue to move on, because we always have a lot to cover this week. Ray, I want to hear more from you, because it looks like you're looking at some of the outflows and inflows for CEXs versus DEXs. Again, this is a child-friendly podcast, okay? Don't let your mind go somewhere. So tell us, what's on your radar this week?
Yeah, I think I'm going to be the positive voice, the bull in the room today. And SEX refers to centralized exchanges, not that other adult activity that some folks engage in. So, but for the sake of YouTube and I guess SEO,
right? I appreciate you clarifying.
Yeah, I need to clarify that for anyone that's under 18. But I'll just use the non-acronym. I'll use the full term. I need about a minute to set the context before I actually talk about the chart that I'm feeling bullish on. So, all right, let me go. So, centralized exchange trading volumes fell to a 4-year low, and that was before the SEC crackdown on Binance and Coinbase. And, trading volumes on centralized exchanges hitting a 4-year low occurred as it continued as regulators cracked down with their enforcement whip, right? So one thing that we all know, anyone that's been in crypto for a year or two, is that when centralized exchanges come under duress, there's been a trend of deposits or inflows to decentralized exchanges, seeing a bump in inflow. And with the severity of the current bear market, of course, the TVL and activity across DeFi and DEXs with perpetual contracts, it's been a bit of a whipsaw here and there, but the trend remains. And with some of these centralized exchanges looking like they're either going to have to bend the knee to regulators or cease to maintain their crypto market share dominance, it's kind of a no-brainer that decentralized exchanges are positioned to capture traders who utilize futures instruments or live in places without adequate financial infrastructure or have a preference for avoiding KYC. Let's look at some numbers. In the past 24 hours, DEXs saw 1.7 billion in volume and 14 billion in the past 7 days. So essentially, there's been a 28.2% change in DEX volumes to the upside. You can compare that data at DeFi Llama against centralized exchange outflow, and you'll see that Binance in a month has had 2.8 billion in outflows, and Bitfinex has seen outflows. Crypto.com has seen outflows. All the major centralized exchanges are seeing people withdrawing their Bitcoin and Ethereum and self-custodying or taking it elsewhere, right? So what am I looking at? Go ahead.
I'm gonna break you in. So you're just at the 2-minute mark. I will say you get an applause because you had all the numbers with you. So I'm going to give you credit for that one. So, okay, to summarize what you're looking at, you're seeing the continued trend of decentralized exchanges picking up volume and for a variety of reasons. And you're looking at this as something that's just going to continue on. You don't see any reversal, perhaps something near term, but nothing that's going to be, it's just to continue it on, right? You're not expecting this to change, are you?
Not at all. I think it's a well-known trend also that decentralized exchanges in the last year have seen an uptick in activity and inflow when centralized exchanges come under regulatory duress. I don't expect that to really change in a meaningful way until we have a regulatory framework in the United States that allows Fidelity and all these other kind of big brokerages to offer without risk to themselves crypto services to retail investors and make it easier for institutional investors to use exchanges here instead of having to use FTX overseas or some shoddy whatever levered exchange in the Seychelles.
I guess a question I have, and I imagine a lot of traders have this. There's obviously the benefits, as you just mentioned, in terms of perhaps the anonymity, just access to products that are considered banned in your jurisdiction. And again, we're not recommending any of these. This is entirely do your own research and apply the rules in your own jurisdiction. I guess, but there's typically a set of drawbacks that happen with these DEXs. You can have slippage on price. Liquidity can be very thin. Do you see that changing? Obviously, volume is going up, and as you mentioned, it may be just a flight from the centralized exchanges, but do you see the advancements at the protocol or the application layer that's going to really make these mature enough to be able to compete once the regulations catch up?
I honestly don't know. I think DYDX stands to remain the market leader, and GMX is multi-chain, but I mean, they don't have majority market share of perpetual decentralized exchange, whatever, services. So I really don't know. I can't say, to be honest. I don't think it's preferable. Most people, I don't think, really want to use a decentralized exchange for perpetuals, but if that's the only option they have, then those that like risk are going to use that, right? But I don't think you would see Travis Kling or Ben or from J Labs or any other kind of regulated fund using perps. They're not allowed to, and it's too risky.
Yeah, it becomes like a self-fulfilling prophecy, though. Like if enough retail start using these things, if that keeps increasing, then I think you'll see market makers ultimately come there because there's a market to be made and they can make money. So liquidity will rise as retail adoption increases. Yeah.
So can I talk about my token?
You can talk about your token.
It won't take forever.
I'm going to give you a minute. I'm going to give you a minute here, Ray.
Got it. Okay, that's why I talked about DEXs, because GMX Exchange and its token has me interested. So the price of this token is down 51% from its all-time high at $89, which happened in mid-April, about 3 months ago. If you overlay GMX price action with Bitcoin price action, you can see that the two move in tandem, which makes sense given that investors with risk-on sentiment and during euphoric times are adding margin to their leveraged trades, which in the case of perps exchanges will be on the long and short side. Hence, open interest rises, and we see activity at GMX DEX increasing on-chain and in money flow. So when sentiment pops, we get liquidations, OI drops, retail traders withdraw or are forced out of the market, and GMX price corrects. Nothing is given, and it's possibly safe to assume that as risk sentiment returns to Bitcoin or this current FUD dissipates, traders are going to hop back into the market. We should see cumulative OI rise, and thus DEX activity should rise, and TVL of DEXs should rise too. which is why I'm bullish on GMX token in the short term.
In the short term, not a short description, but in the short term. I like that you're looking at a GMX and you've got a potential trade for people. Again, none of this is financial advice. Nobody on here. We're a bunch of anonymous characters in cartoons. Do not listen to us for advice. But if you're interested in some commentary, here's a few things to consider. So yeah, the GMX token sounds like an interesting play.
Yeah, I like that he mentioned GMX. I also like the token, but I'm kind of disappointed that he didn't jump into Raycoin. For a split second, I thought Ray had launched his own token. And said, yeah,
I was waiting for that one too.
yeah.
You know, Cody, I think you're the kind of person that could help design those tokens, right? Aren't you someone who could be looking at the token economics?
Yeah, correct. We have a team in house with Ben and Rishi. So if any of y'all want to design a token, just let us know.
And that's the team that was very bearish on the ARB token and the airdrop there. And I just want to quickly point out that look at the top of that price on GMX chart. Interestingly enough, it pairs up with when the ARB drop happened. Just saying.
I mean, yeah, if you want to look at the trend, like just look at Blur.
All right, so if you're interested in knowing more about Raycoin, let us know in the comments. We'd love to hear some thoughts, and if you can help us design, we'd love to hear if there's something you want to add. All right, let's move on, Ray. That was a great segment. Let's move on to our next segment, Like It or Spike It. We're going to be asking Cody a couple of questions about a couple of projects and a couple of tokens. So, Cody, you ready to unleash your GigaBrain?
Yeah, help me.
Okay. All right. So the first one we got here, we got Curve co-founder Michael Egorov. If I pronounced that incorrectly, I apologize. Deposits 38 million CRV tokens, which is around 25 million USD, into Aave to mitigate liquidation risk on one of its loans. Like it or spike it?
Spike it. Just to put things into perspective, Michael Egorov, he founded Curve. So as a co-founder, he controls a lot of tokens. He took a loan on Aave V2 for 250 million tokens, which is around 32% of the total supply. So this one individual is controlling 32% of the total circulating supply, a token. And he took a loan for 65 million. Curve, as all of the DeFi tokens particularly, has been in a tantrum for like ever. And his loan was about to get liquidated. And to be honest, I don't had he not put up more collateral in the form of even more CLV tokens, his loan would have been liquidated. I'm not sure there's a way to liquidate a loan safely if the loan to be liquidated is 30+% of the supply. So yeah, I'm very sure, and I genuinely do not like the fact that one can take up such low number.
Yeah,
it's important to say though, yeah, Aave V3 does have a supply cap on the amount of tokens you can get a loan for, but V2 did not. So some insiders took advantage of that.
Okay. All right. No bueno. All right, let's move on. ETH Validator withdrawals from Beacon Chain continue creeping up. Like it or spike it?
Spike it. Yeah, as Ben mentioned before, the validator exit queue keeps moving up. Last week was like 1,500 validators total, more or less wanted to get out. Now it's up to 5,500. And that's not as many validators as there are in the enter queue. Not nearly, like right now there's like 90,000 validators that want to enter. But yeah, those 5,000 validators, that's equal to 180,000 ETH, which is around about $300 million at current prices. And liquidity is not great lately. Ever since the SEC spreads have widened, some market makers have pulled out. And if they were to sell into the market, prices will probably go down. I don't think there's demand for that ETH. And it's like a vicious circle. The more validators exit and sell, the more validators get split and one exit as well. And yeah, sorry, but I'm also on the very sad today.
Yeah, you're also on the bear train. Thank you so much for bringing. Let's move on. See if we can find some optimism here. I don't think, on this next one. ETH on exchanges versus locked ETH. Like it or spike it?
Oh, I actually really like this. I think it's a sign of validate and the general market trusting ETH and the Ethereum team and the work that they have done. As we saw, like the amount of ETH that was staked on the Beacon chain has been creeping up, and now it's going asymptotically higher as people trust the reward system and the ecosystem. And like now there's around about 33 million ETH staked and around about 34 million ETH on exchanges. And those lines are going to meet soon. Validators keep adding ETH to the Beacon chain, and people keep exiting centralized exchanges, both because they do not trust these centralized solutions and because they want to earn yield on the ETH. So, positive development, and it's fun to talk.
Yeah, seeing some good maturity on Ethereum. Glad to have some positive news. All right, let's get to the last one here. We got Blur loans. Like it or spike it?
Like it. Yeah, Blur, like the price wouldn't tell you so because it's just been, it's just fallen off the cliff. It has been down only, but let's say the fundamentals of the project just keep going up. Blur launched the lending market a few months ago called Blend, which is a peer-to-peer lending market. You and I can take a loan on any NFT that you want. And they released it 3 or 4 months ago for the various NFT market that it was kind of like gated to list. And lately they opened the market for NFTs, and now the volumes for lending rival the volumes for the spot market. So people are lending as much as they are buying on Blur. And Blend totally dominates the lending market for NFTs. Last week, they controlled 96% of the volume. The week prior, 93%. And unless someone comes up and releases something cool soon, they are just going to run with it. And they're going to be the place to lend NFTs on.
So if you're looking to get a loan off of your Bored Ape or your Pet Rock, this is the place?
Yep.
All right.
It's the only place that has any volume. So
it's the only place.
Yep.
Okay. All right. Well, there you have it. We got 2 spike it's, 2 like it's. So we're kind of halfway. We're in the middle of a little bit of optimism. Thank you, Cody. Appreciate it. All right. Let's spend a little time talking a little more about Ethereum, because you haven't heard enough on this podcast. But we talked a little bit about Ethereum yields, and Ben, you put out an article, I believe this last week, talking about, and you spoke about it just earlier in the podcast, about the difficulty with getting rates. And so I guess I wanted you to expand a little bit, Ben, on that and talk a little bit about the potential maturity of us getting a better sense of the rate landscape. Can you just expand on what you put in that article?
Yeah, data is black and white, but it's how do you package it up? How do you run a calculation? And how do you determine what that metric is? There's a lot of different ways you can cut that. And Cody here has done a lot of work on that for us on our upcoming product launch, Panda, that has to do with what the yields actually are and the ability to even figure out what is it relative to a certain asset. Because if you want to go ahead and drop a token into a pool, and somebody's already advertising 20% APY on that asset, like what is it relative to? Is it relative to US dollars? And is that US dollar fluctuating on a daily basis? Is my starting point today, or is it 30 days ago? What has that yield been doing over time? A lot of these projects don't even showcase that. And I mentioned the changing in yield over the next 3 months, and then how that can dictate how you might position yourself and your portfolio. Those conversations can't really be had because we don't really look at yield over time relative to how much transaction activity might be taking place or why a protocol might become more bullish in future events. These conversations are being had, but not enough. And when it comes to data, right, there's just so many ways that you can spin it to make it tell the story that you want to tell. And a lot of times you might even see 4-figure APYs on a website, and that might have a secondary token involved.
Well,
how do you even bring that into the picture?
Yeah, so Ben, what about the question? I mean, this isn't a unique problem to crypto, is it?
It kind of is.
You think because you're thinking of these as sort of, if you compare it to sovereign wealth, I mean, I'll say if you look at like bonds coming out of Argentina, bonds coming out of Turkey, they can have very high rates of return, but they're effectively junk bonds, right?
Yeah, and that process begins with an auction that kind of dictates what the price of that bond is and what that yield associated with it is. And then from that point forward, that gets traded in a secondary market. And so the yield and the expectation of that yield changes every day. And that has to do with the underlying price of that bond. And we don't have those secondary markets in the same manner within crypto yet. The only way that we really do look at yields is what has happened, because that is the actual yield that you're receiving versus trying to sell what this bond is, which is a repayment of debt over time. We don't have that secondary market yet. And I would have to imagine that's going to be one of the, not strongest narratives, but it's going to be a good narrative that unfolds as that market starts to get more robust, especially as this validator queue, which has swung to one side with over 90,000 validators waiting to get activated. Like we have swung too far with yields getting compressed. And eventually it'll probably swing the other way. People are going to be moving ETH to other ways of earning yield. And eventually the need for the secondary market is going to arise.
Now, I'm curious, and I asked the rest of it, the audience or the group here, what kind of activity are you looking for in terms of development? I think JJ, you mentioned you're expecting this over the next 18 to 36 months to really plan out, and we're going to start seeing some of that development of that secondary market. I guess what kind of signals would you be looking for?
I think ultimately, like the need for yield in crypto will arise from the vacuum created in legacy again. Like I don't think we're going to be at 5% rates forever, and ultimately, like the rate that they're going to be able to pay out is unlikely to keep up with inflation over time. So I think just naturally we'll kind of see this organic demand arise, and ETH will be the place where that transfers to. But that said, it's probably going to be a multi-year process. This isn't something that happens overnight unless something drastic were to happen in rates markets like tomorrow.
Yeah.
But it will happen.
Like you mean a Balaji type of event where everything is going to crater?
But and also like everything that's been happening since say 2020 is kind of like proof of concept, testnet type, like where everybody is experimenting with these things. And that's what I think people, onlookers, don't necessarily realize. And they may take too much risk with these yields, but a lot of it is just kind of testnet operations. It just is right now, right?
Yeah.
Is where people will see what works and what doesn't, what blows up and what's resilient. And we're kind of figuring out through trial and error kind of a good sustainable way to do this. And I don't think we're there yet, but I think it's kind of coming slowly, gradually over time, and these things will improve.
Cody, I want to ask you, there's obviously thousands of projects, so you can't have a finger on the pulse of everything that's happening. Do you, though, are you aware of any sort of maturity or applications or protocols that are looking to specifically focus on a secondary market that could help bring this about? Sort of a secondary market as we're looking for these yields for Ethereum. Anything that would be promoting that?
Yeah, there's a very interesting project called Pendle, but to be honest, I haven't really had the time to look that much into it. Maybe Ben can give some color on that.
I haven't had time to look at it either. The team did reach out and kind of say, hey, take a look, and haven't spent the time to quite dive into it. But there looks to be something promising there. But in order to get there, other things need to happen. First, like we mentioned, the validator queue is starting to stack up. But you also need kind of more use cases of ETH, relative to, okay, this other protocol that maybe launched a week ago, like, do I actually trust it with my ETH? I don't know. What's the risk involved? What is the actual APR? What can I expect? And once those things start to get ironed out over time, and there's a lot more competition to try to attract the ETH in your wallet to that protocol, these things will then start to mature the right way.
I think it's valuable to remember that ETH didn't go from $4 to $400 to $1,400 in 2016, 2017, back to $80 to $40 in 2018, 2019, back to $80, then all the way up to $4,000. None of that happened in a short time span, and where prices now and where yields are now, as JJ says, are a bit of experimentation and a lot of people just kind of modeling and like ideating and testing. And I agree with JJ that we need a switch to flip sentiment back to risk on. So eventually the Fed's got to hit that terminal rate. The current inflation report puts us at 4%. The target's 2%. Maybe we get a hard recession. Yields eventually come down in TradFi. And for some reason, maybe yield will be sought out in Ethereum again. But at the same time, I think like what we saw in Hong Kong or China this week with a major bank there launching some of its banking on an Ethereum contract, I think regarding yield, we need to see more TradFi, real-world assets and such come onto the ETH blockchain and begin to package that yield into products that provide yield for investors who are not in crypto and are not crypto native. I don't think that the search for yield solely within crypto and DeFi, it's not sustainable. Previous DeFi cycles have shown us that the lack of risk or the weird multi-sig wallets or the hidden bad players or the coding errors or the hidden leverage or like blatant in your face leverage lead to destruction of ETH price, right, and other crypto prices. So that's the ultimate thing I think we need, is that switch that Cozy talks about, and more so that yield to be packaged into regulated products in the real world. That way it has a little bit more, it's a bit more concrete and robust and reliable and perceived as less risky.
That'll be the tipping point when people don't even realize they're invested into ETH and it's just packaged as, your run-of-the-mill TradFi product that's sold by an investment banker to some elderly person in their 401k, and they don't even know where
You're buying a company.
Just like...
Yeah, you're buying a company that has exposure to ETH yield or has allocation to ETH for yield as part of its own portfolio that you're unaware of, but you've just bought the company. Exactly. Like if Tesla had exposure to ETH and I buy Tesla stock because I'm bullish on their new infrastructure being used by GM and Ford across all of America for charging stations. So I'm buying Tesla stock, but they themselves have access. They're invested in Ethereum for the yield component. That sort of thing is what I'm looking for over the next 2 or 3 years.
Yeah. Well,
or within the decade, it's just not there yet,
Well, I'm excited because I know with all the doom, oftentimes we're very short-term price, but the opportunities within this space to me continue to be very, very broad and bold and exciting. So this conversation reminds me of that. So if you're out there and you've been surviving the crypto winter because you're a bear market warrior, hopefully this gives you a little bit of optimism as well. And we're all in this for the long term. If you're in here for the short term, sorry, buddy, you ain't gonna last. But okay, let's wrap up this part of the conversation. Move to the last one. We're gonna end with a little bit of banter here. So, Jim Cramer, one of our favorite analysts, who's I think a 10 out of 10 on all of his calls, he said it's time to get out. And this was a quote, which probably isn't even a quote, but something to the effect of, as the crypto lawsuits pile up, Cramer says it's get out while you can. I'd love to hear the audience. I'd love to hear you guys talk about this. What are your thoughts? What would you say if you saw Jim Cramer at the comment?
We need more Cramer FUD. It's the best.
Oh, you want more? Okay.
It's the best antidote for everything we were discussing earlier in the show. All the reasons why we're bearish. Properly timed Cramer tweet can possibly cancel that out. So throw some more fuel on.
Yeah, I would say counter trade alert.
I think he's just scared to embrace blockchain, put that wallet, see transparently what's going in, what's going out. He might be on edge if that were to happen. So of course he's going to shoot this down.
Well, he was all in FTX, I believe, if I remember. It was,
of course he was. Yeah. Yeah, but just need to keep giving us his takes, because the only reason I'm not broke is because every once in a while they get to counter him. So please to keep them coming.
Yeah, he was also short Nvidia, or told people to get out of Nvidia before it blew up. So he's basically the ultimate counter trade signal or alert. And I would say that it's all part of his shtick. You know, Cramer, he does this intentionally to rile people up and get publicity and to get people to watch Squawk Box. I don't think he's intentionally putting out bad calls, even though he does. But
He knows how to make headlines.
Can he start talking about altcoins?
Please. Yeah.
We'll put it in a request. I guess a question: has anybody ever had their Series 7 revoked for being wrong?
You should. If anybody should, it's him. He should lose it over just his sheer how many times can you be wrong and still be certified that you're an expert?
That might be part of the certification process.
Yeah.
Got to be able to go on Squawk Box to be able to talk about your poor calls. Oh man, Benjamin, you're kind of silent there. I'm not sure. Maybe you've got an inside DM track to Papa Cramer. Any last thoughts before we wrap up today?
Cramer, I don't know. I think we need another for that. Yeah,
Sorry,
I think we need another hour if I have to start talking about Jim Cramer.
Oh my gosh, that is perfect. That is a great way to wrap up this show. That's going to do it for this week. Appreciate everyone joining here. This week's guests, we had JJ, Ben, Lily, Ray, Cody, and Benjamin. Thank you, gentlemen, for being here and sharing your insights as we try and find alpha in this crazy market. And listen, if you're out there and you're looking for more content, be sure to subscribe to the Exchange Good channel on YouTube, so you're never going to miss this broadcast or any of the other content that we're continuing to build, because it's a bear market, but we're continuing to build because we know that we're here for the long term, and that's the best way to survive it. But for now, I hope you enjoyed this. Let us know in the comments if you've got questions for what you're looking for. I will say one thing before I wrap up. There have been requests for data. We are looking at how to do that. Until that time, just let us know. I just want you to know that we're thinking about it. But until next week, this is Marconi White signing off.